Hello students, you are the future chartered accountants of India. I am CA Abhijith Acharya welcoming you all for Abhi CA classes. We have discussed till PGBP chapter. Now we are going to start with the fourth heads of income, that is capital gain. So we are left with only two heads of income, that is capital gain, and the last one is income from other sources. Today we are going to start the fourth heads of income. This is also forming a A category. It's also very important from your exam perspective. And this is today we are going to start the fourth heads of income, that is capital gain. Okay, without wasting further time, we'll discuss the today's topic. Many of you are trading with shares or mutual funds or F&O, or your family members are trading. What if you sell those the shares or mutual funds? The capital gain will arise, right? So that concept we will discuss theoretically in today's topic with the practical examples. So the first section, 45 subsection 1, says that it is a charging section. Any profit and gain arising from the transfer of capital asset shall be chargeable under the head of capital gain in the previous year in which the transfer took place. For example, if you sell the shares, long-term shares or short-term sales in 23-24, the transfer is being taken place in 23-24, and hence accordingly the capital gain or loss will arise in that financial year. Okay, the simple concept, the capital asset. Okay, then first we have to see what you mean the definition of capital asset. It has been mentioned under section 2 section 14 of the Income Tax Act 1961. The capital asset means the property of any kind held by the assessee, whether or not connected with the business or profession. Any securities held by the foreign institutional investors. The second one is, it excludes stock and trade, because stock and trade will definitely come under the PGBP concept, because if you sell your stock and trade, then you are liable to charge the income tax under the head PGBP, right? That we have already covered in the PGBP chapter. Then thus it also excludes movable personal property user by the assessee or his dependent family member for his personal purpose. For example, car, TV, etc. But movable assets do not include the jewelry, drawings, paintings, sculpture, archaeological collections, or other work of art. What do you mean by this? This means these are also considered as capital asset, and transfer of these would arise the capital gain concept. What it says, what it excludes the capital asset excludes the concept of movable properties which are used in the personal in nature. However, the following, that is the exclusion of exclusion, which is indirectly it is inclusive. Okay, the movable assets do not include jewelry, drawings, paintings, sculpture, archaeological collections, and other work of. If you sell these, if you transfer these categories, even though they are treated as movable asset but personal asset, but also the capital gain concept will be applicable. Okay, then the capital asset do not include the rural agricultural land. It is not saying the urban agriculture, it is saying only rural agricultural land. Then the gold deposit bond 1999, which is, you might be actually aware of the concept of SGB, that is sovereign gold bond scheme of 2015. Okay, these four categories are not including under the capital asset. One is stock and trade, second is movable personal assets. That also excludes some of the items, that is jewelry, drawings, painting, etc. And the rural agricultural land and the gold deposit bonds. Okay. Then the capital asset also includes the unit linked investment plan, that is in short is collectively called as ULIPs, to which the exemption under section 10 subsection 10D does not apply due to the fourth or fifth proviso thereof. Okay, then some important notes: the TV, car, mobiles are not capital asset, even though they are treated as movable asset, and so hence capital gain would not arise. But car used in the business is treated as capital asset. If I am having a trading business, my car is using for trading purpose, if I sell that car to anyone else, then the capital gain would arise. Okay, simple. But if I am not having any trade, if I'm not using any car for my trading purpose, then if I sell that, if I transfer that car to any person, then capital gain would not arise. If I use the car through my trading business, then only that capital gain arise to the car. Simple. Then definition of urban land. We have seen the rural agriculture land. If you sell the rural agriculture land, the capital gain would not arise. But what do you mean by urban agriculture land? We'll see the definition. The area which has the population of more than or equal to 10,000. If any area is equal to population of more than 10,000, this concept we have already discussed in our first concept, first chapter, that is basics. In that we have included that rural agriculture land something. Okay, the area which has a population of more than or equal to 10,000, that's also considered as urban agriculture land, urban land. And if you sell that urban land, capital gain would arise. Okay, then in the following distances measured aerially, if the population is in between 10,000 to 1 lakh, and if you are if your area is, if your land is situated up to 2 kilometers from municipality location, here it is municipality up to 2 kilometers. If your land is located in that land, the population is more than 1 lakh, more than 10,000 up to 1 lakh, then also that is considered as the urban area. We will see one example. For example, up to 2 kilometers, that is, for example, 1 kilometer. 1 kilometer from municipality located up to 1 kilometer, up to 2 kilometer. Even in our example, it is 1 kilometer. Population is 9,000. Okay, 9,000. So it is not treated as urban land. It is treated as rural agriculture land, and hence capital gain would not arise. In our the definition, up to 2 kilometers, the population should be more than 10,000 up to 1 lakh. Then only any land situated in that location would be treated as urban land. In this example, even though it is up to 2 kilometer, but the population is below 10,000, it is not ranging between 10,000 to 1 lakh, then it is not treated as urban land, it is treated as rural land. Okay, then up to 6 kilometers from the municipality, up to 2 kilometers over, up to 6 kilometers, the population is more than 1 lakh up to 10 lakh. Any land situated in between that distance, then that is also treated as urban land. If, for example, we'll see the next example, 3 kilometers up to 6 kilometers, right? 3 kilometers, the up to 3 kilometers, the land is situated. The population is 80,000, right? But the population 80,000 is below 1 lakh, and it is not treated as agricultural land. It is rural land. It is treated as urban. It is treated as rural land. It is not treated as urban land. Okay, I hope you are understanding this concept. Next, up to 8 kilometers, up to the municipality limits, up to 8 kilometers, but the population should be more than 10 lakh. In that location, the population is also satisfying, then the land is treated as urban land, not rural land. Okay, so we'll take another example, the 4 kilometers, the 4 kilometers, the land is situated. You can see up to 6 kilometers is covering, but the population should be more than 1 lakh up to 10 lakh. Here the population is 3 lakh, so it is ranging in between 1 lakh to 10 lakh, and hence it is treated as urban land, and also capital asset, and also capital gain would arise. Simple. Next, section 2, subsection 47, discuss the meaning of transfer. Transfer includes the sale, exchange, or relinquishment of the asset. The relinquishment means we'll leaving that liability over the asset. We are not having any control over the asset. It is called relinquishment. The extinguishment of any right there, the compulsory acquisition of under any law. If you are the owner of any property nearby the road construction, the state government or central government to construct the national highway, they will compulsory acquire your property to broader the road. For that, you will get the compensation from that. It is also treated as the capital asset. Okay, the capital gain, the transfer, the conversion of capital asset into stock and debt. If you are hold, if you are having any of the asset as under the capital nature, if now we are trying to convert that to stock in trade, then that is also considered as the transfer. The any transactions like becoming a member or acquiring the shares in a corporate society which has the effect of transferring or enabling the enjoyment of immovable property. Ultimately, it is also treated as transfer. The redemption of zero coupon bond, that is also treated as transfer. The types of capital asset, we have discussed the short-term capital asset and long-term capital asset. The definition is the STCA or LTCA. The nature of capital asset, in which situations we are classifying the capital asset as long term or short term. First, we'll see three categories. The number one, the first one, the securities other than unit. Other than unit means other than mutual funds listed in a recognized stock exchange. In simple, it is stated as listed equity shares. The second, unit of UTI. In the first, we have excluded the units. Now we are considering the units of UTI or equity oriented mutual fund. Then zero coupon bond. If you are holding this much of, if actually any of these capital asset, then if you are for up to 1 year, up to less than or equal to 1 year, it's treated as short-term capital asset. If you are holding for more than 1 year from the date of acquisition, it's treated as LTCA. For example, if I bought the one listed equity shares of ITC Limited in the month of December 2023, I am transferring that one shares of ITC Limited in the month of March 2024. So it is less than 1 year. I am holding for less than 1 year, so it is treated as short-term capital asset. Whereas if I am holding for more than 1 year, then it is also treated as long-term capital asset for these the nature of assets. Okay, the second the category, we'll see the unlisted shares. If you are holding any unlisted shares which is not been listed in a recognized stock exchange of India, Bombay or NSE or BSE, or immovable property, if you are holding any property or a land for up to 2 years, it is treated as short-term capital asset. For more than 2 years, the LTCA. If I am holding any property or land for up to 2 years, it is treated as short-term capital asset. If more than 2 years, it is treated as LTCA, that is long-term capital asset. Any other capital asset apart from these categories, if you are holding for more than 3 years, it is treated as LTCA. Up to 3 years, up to 3 years means less than or equal to 3 years, then it's a short-term capital asset. Okay, then the section 48, this is very common, the computation of capital gain. This one format you have to prepare the same format in examination also for the capital gain concept. The full value of consideration, in other words, it's treated as sale proceeds, but we have to use the terms full value of consideration, FVOC. In short, we are treating this minus that amount should be reduced by any expenses incurred in connection with transfer. It is also collectively called as transfer expenses. We have to reduce that to arrive at net consideration. Then also you have to reduce that cost of acquisition, that is in terms of cost of purchase cost, or we have to use the terms cost of acquisition. And also you have to reduce cost of improvement, any improvement of in the terms, for example, if I am I am having one property, I am incurring some of the capital expenditure in order to improve that any of the asset any of the building, then that is also called cost of improvement. You have to reduce the cost of acquisition and cost of improvement to arrive at the final capital gain. Okay, note the land and building are two separate assets. If land is purchased 2 years before and building is constructed within 2 years, then land is treated as LTCA. Why it is land treated as LTCA? Because in the second category immovable property, if you are holding up to 2 years, it is treated as STCA. More than 2 years, it is treated as LTCA. In this example, the land is bought before 2 years, prior to the 2 years, and it is treated as LTCA, and building is treated as short-term capital asset. Very important. The second proviso to section 48. Proviso means it is an exception to 48, section 48, any of the section. In case of long-term capital asset, COA, that is cost of acquisition and cost of improvement, should be indexed. The meaning of indexation is it's simply giving an effect to the inflation rate, because 100 rupees of 2000 or 100 rupees of any item in the year 2005, let's say example, is not equal to 100 rupees of today because of inflation. You cannot buy the same thing worth of 100 rupees in 2005 as of today, right? This is called inflation. This is because of inflation. So we have to, because the land has been, for example, I have acquired the land, for example, 5 years back. The worth of that land, let's say at that point of time, is 10 lakh. The same is not equal to 10 lakh as of today, because you can compare the same sense, same acre is not worth the same amount due to the inflation. So we have to increase that land cost of 2005 in order to match with the same cost as of now, by computing one of the formula. That is, let's say, in as per income tax, there is one formula we have to utilize in order to match the land cost of that purchase date as of today. So indexed cost of it is applicable only for long-term capital asset, right? It is short-term capital. Logically, it is not applicable to short-term capital asset, because in short term the land cost would not vary so much, but in long term it would vary so much because of that inflation, right? The indexed cost of acquisition, we have to reduce the cost of acquisition and cost of improvement accordingly, but we have to use the word indexed cost of acquisition and indexed cost of improvements for long-term capital asset. The cost, it is some simple formula. The cost of acquisition, let's say 10 lakh, into cost of inflation index of the year of transfer, let's say in 23-24. What is a CII of 23-24? The CII would be provided in the question, but for the 23-24, if it is not given, we have to take the 348. It has been given by the income tax authority. Okay, for CII I have mentioned the CII for 23-24 is 348, and CII for 2001 and 2 100. Before, if you have purchased any of the land before 2001 and 2, we have to use the CII of this year only, that is 2001 and 2. Okay, usually it will be provided in the question, but if any question is silent about the CII for 23-24, then you have to consider 348 and also mention in the notes. For any other area, it would be guaranteed provided in the question. Don't worry about that. Okay, you need not by heart everything, but you need to remember the word or the CII for 23-24 as 348, for 2001 and 2 as 100. Simple. So formula is COA, the cost of acquisition, that is 10 lakh, into CII of 23-24, that is 348, divided by CII of purchased cost, the purchased year, or 2001 and 2, whichever is later. Okay, if for example, if I have bought the land in 2003 and 4, the CII of 2003 and 4 would be given in the question. Don't worry. So in that case, the formula is the 10 lakh into 348 divided by whatever the CII given in the question. If the land is bought before 2001, then we have to take the CII of 2001 and 2. So the formula would be 10 lakh into 348 divided by 100. Then you will arrive at the indexed cost of acquisition. Normally, the 10 lakh should be increased. That's it. If you are arriving any of the actual amount which is less than, which should be more than 10 lakh because of that inflation. If it is arriving the less than that 10 lakh, then there is some error in your actual workings. Okay, then the same concept is applicable to indexed cost of improvements. So you have made any improvements in some years ago, then the formula would be the actual cost of improvement into CII of the year of transfer, that is 23-24, divided by the CII of the year of improvements would be given in the question. Don't worry. Then the asset acquired before 2001, the cost of acquisition should be taken, the actual cost or the fair market value as on 1/4/2001, whichever is higher. Let's say, for example, if you have purchased the land in 1995, in which the cost is 1 lakh. But the fair market value as on 2001 and 2 is, let's say for example 5 lakh. In that case we have to take the cost of acquisition as 5 lakh or 1 lakh, whichever is higher is 5 lakh. On that we have to take the indexation benefit, that is 5 lakh into CIF of 23-24 divided by CIF of 2001 and 2, not the 1995 the CIF. Okay, it is irrelevant. Okay, the improvement done before 2004 and before 2001 April 1st, then we should ignore them. Simple. The cost of acquisition we have to compare with the fair market value, whichever is higher. But in terms of that improvements, we have to ignore that the cost of improvements before first for 2001. Okay, as per section 47, no capital gain would arise in case of redemption of SGB issued by RBI for an individual. If you are an individual, if you are selling an SGB on its redemption date, redemption period, then no capital gain concept would arise. It is fully exempt. Okay, if transferred before the maturity, then capital gain would arise. Indexation also benefit would be applicable depending upon the nature of depending upon the period of holding. Okay, if you are holding for more than 3 years, then that would be long-term capital asset. If you are holding for less than 3 years, less than or equal to 3 years, that is treated as short-term capital asset because it is classifying on a third category. Okay, if SGB is transferred on redemption, SCG, the capital gain would arise for all other SSEs. If you are a company buying the SGB, if you are selling that SGB, obviously that capital gain concept would arise. It is applicable. Exemption is applicable only for individual. Remember. Then security transaction tax, that is in short STT, shall not be treated as an transfer expense. You should not reduce that amount from your sale proceeds. Because the section 48 says there is one formula, expenses in second line. After FEOC, we have to reduce the expenses incurred in connection with the transfer. You need not, any STT paid shall not be treated as the transfer expenses, that should be foregone. You should not treat the same as the transfer expenses. You should ignore that. Okay, the same concept you have mentioned is as per 7th proviso to section 48. Then section 55, the cost of acquisition and improvement in case of goodwill of business or profession, trademark, brand name associated with business or profession, right to manufacture, produce, process of any article or things or patent or copyright, right to carry on any business or profession, tenancy rights, loom house, route permits. If you are incurring these expenses, the cost of acquisition would be, if it is being self-generated, because sometimes the goodwill would be self-generated, it will be automatically if you are amalgamating one company to another company, the amalgamated company will provide you the more amount than actual worth of your company, because it is due to the goodwill. It is been self-generated, so you have not incurred any expenses in relate to that, so hence it should be ignored. So the value of the cost of acquisition would be nil in that case. But you have purchased that goodwill. If you are incurring an expense in terms of that goodwill, then purchase price should be taken as a cost of acquisition. Okay. Then bonus shares. What is the cost of acquisition for bonus shares or securities? If the bonus shares is acquired before 1/4/2001, then fair market value as on 1/4/2001 should be taken as the cost of acquisition of bonus shares. The acquired on or after 1/4/2001, then the bonus shares cost of acquisition should be nil, because you have not incurred any expenses, right? Because the company is giving the bonus shares, you are not incurring any of the cost in terms of that bonus share, and hence if you are provided with any bonus shares after 1/4/2001, the cost on or after 1/4/2001, the cost of acquisition should be nil. Before, we have to take the FMV as on 1/4/2001. Remember, the period of holding shall be calculated from the actual allotment date to the rate of transfer. Why it is important? Because we have to see whether it's a capital gain, whether it's a short-term capital asset or long-term capital asset, depending upon the period of holding. Okay, the right shares, if it is being acquired by the shareholders, Then cost of acquisition would be amount paid to the company. Right shares means, so let's say for example, the actual price of the shares of one company, let's say, is 100 rupees. If you are an existing shareholders, you are provided with the right shares. For example, for the amount of, let's say for example, 60 rupees, you are getting the 40 discount, right? That the cost of acquisition would be the 40 rupees amount paid to the company. The period of holding should be calculated from the allotment date to the transfer date. Okay. Now the renouncement date. Renouncement of right means if you are further selling that right to any other person, in that case the capital gain will be applicable. Renouncement means I am not accepting that. I am just transferring my right to any other person. In that case, I would be responsible for capital gain. Capital gain will arise. The fair market value would be the renouncement base. I will let's say I will sell that renouncement, the right to any other person for a renouncement price. The cost of acquisition would be nil. We do not take any of the cost of acquisition. Then the long term capital gain, the short term capital gain would be applicable depending upon the period of holding. The offer date to the renouncement date. If the date is more than 3 years or 2 years, as a case may be, then it would be treated as long term capital asset. If it is less than or equal to that date, then that would be treated as short term capital asset. This is called renouncement of that right. Okay, in the hands of purchaser of right, if to whom I have sold that right, in that purchaser, the cost of acquisition would be amount paid to the company for shares by the previous year, that is me, plus the amount paid for purchase of right, that is renouncement price, should be taken as a cost of acquisition for his further sale. Okay, the period of holding should be taken from the date of allotment of shares to the date of actual transfer of that shares. Simple. Then in relation to other capital asset, any other capital asset acquired before 1/4/2001, the actual cost of this we have already discussed. The actual cost of acquisition or fair market value as on 1/4/2001, whichever higher should be taken. But in case of immovable property purchased before 1/4/2001, any other capital asset excluding that immovable property, the same cost, whichever is higher. But in case of immovable property, the purchase before 1/4/2001, then the cost of acquisition would be as follows. The cost of acquisition should be taken, or then the SDV, that is stamp duty value, as on of that immovable property. Immovable property include the land or building both. On 1/4/2001, or fair market value of that land and building on 1/4/2001. Actually, between these we have to see whichever is lower, SDV or fair market value, whichever is lower. That lower amount should be compared with actual cost of acquisition. Whichever is higher should be taken as cost of acquisition. I will narrate once again. First we have to see SDV and FMV, whichever is lower. That lower amount should be compared with the actual cost of acquisition. Among them, whichever is higher should be taken as cost of acquisition in order to compute the capital gain. Simple. In all other capital asset, we have to see before 1/4/2001 cost of acquisition or FMV. But in case of immovable property, we have to compute one more extra. We have to see one more extra, that is SDV, should be compared with fair market value, whichever is lower. That lower amount should be compared with the actual cost of acquisition, whichever is higher of them should be taken as cost of acquisition for computing the capital gain. Simple. Then what do you mean the cost of improvement? In case of goodwill, patent, copyright, right to carry on business or profession, in that case the cost of improvement would be nil. In any other cases, the capital SA expenditure incurred after 1/4 on or after 1/4/2001. Before 1/4/2001, we should ignore that. Okay. Then till now we have discussed the first part of this chapter. Exception to section 45 of section 1 we'll discuss in detail in the next part of this chapter. Till then, please revise this concept again and again. See you then. Signing off, see Abhijith Acharya. Bye bye. Abhi CA.